I'm Dylan Marma, and you're listening to Operators and Allocators, a podcast dedicated to exploring how to make smart investment decisions and execute well in real estate and private equity. We'll be interviewing top-notch sponsors from various asset classes to understand how they think and the frameworks that they put in place with the goal of achieving above-average risk-adjusted returns. Welcome back, everyone, to another episode of Operators and Allocators. We are in for a very special episode today. We have a great guest on today's show. We have Mr. Logan Freeman. How's it going, Logan?
Energized, thriving, and focused, ready to have this conversation, just marveling at your backdrop. And I hope it's real because it's amazing. But anyways, just excited to be here, Dylan.
My man, love it. Well, yeah, it looks like I'm glowing today for some reason. We have the Tampa backdrop, and I can't quite get the lighting right yet, but it's a work in progress as it all is. But Logan is definitely someone that I'm excited to have on today's episode. I think all of our listeners are going to get a lot of value out of listening to him. If he's someone you have not been following, I highly encourage you to plug in with what him and his team have been doing. Logan, I believe, got started on the brokerage side of things, and he'll correct me if I'm wrong, right? But he went out and did over 100 transactions in the brokerage world. So he started off by really serving investors that were buying real estate, and he was able to learn a tremendous amount along the way. And then when it came time for him, I think he hit a point, and we'll hear more about what inspired this, but he hit a point where he said, I want to get a piece of the action on the investment side and really scale a meaningful platform to begin to serve, passive investors. And that's when he created FTW Investments. He's an advocate for affordable housing, and he has went out and purchased a lot of multifamily in the last couple of years, and he is also now getting into some additional asset types and strategies regarding multifamily that we're going to be able to learn about. But I say there's not many people that have been able to scale as quickly and also as well as he was able to. And I attribute a lot of this to him building a really solid foundation before sort of taking off and launching. So I'm definitely excited to hear what went into that. So Logan, I don't know if that background serves you well, but maybe you want to just kick it off and add any additional color to that, or just share with us how you got your start.
Yeah, absolutely, Dylan. That was really good. So thank you for that. And it's my pleasure to be here today speaking to your audience. And it's always an honor to be able to share some time and hopefully some advice and or just learnings. That's probably what it is more than anything. It's just my experiences. But, I'm a Jefferson City, Missouri boy. That's the capital of Missouri, and grew up, baling hay and washing dishes. And, when I was 14 years old, I'm a big guy. Can't really tell it here. I've lost a little bit of weight, which is good. But I was an athlete my whole life, man. And that brought me to college, playing collegiate football and a little bit afterwards in the NFL. And, that didn't work out. And so I decided to go back to school and get my master's degree. But when I got that, degree, or when I transitioned from being an athlete, really a big shift happened in my identity. And that's kind of what changed everything for me. It was like, okay, you're no longer an athlete. That's no longer defining you. Not necessarily should that be defining you, but I'm an all-in obsessed type of guy. And so it did define me. And that's probably why I had some success. But, that was no longer in my wheelhouse. And so I really dove into my studies, and I got a job. Making 265 cold calls per day. I had to drive an hour to work, and I turned my car to the classroom on wheels, started listening to Jim Rohn and Tony Robbins and Lewis Howes and John Lee Dumas and, the Rich Dad, Poor Dad guys. And that really started to kind of not just flip a light in my head, but really opened my eyes to kind of some different opportunities. And as a football player, I was 335 pounds. In that same amount of time, about 6 months, I lost over 110 pounds. And so I legitimately walked into one of my classrooms one time, and some of my good friends, I walked past them and they didn't say hi because they did not recognize me. They had not seen me for 3 or 4 months. And that also shifted my, perspective on life, on goal setting and things that you can achieve if you're disciplined and focused. And so, I was getting ready to graduate, right? Master's degree, had a job in Kansas City. I was ready to go. And my dad, strapping Native American man, 6'3", hit a golf ball 300 yards, dunk a basketball, you name it. couldn't walk up the stairs to help move me out of my apartment. And so my whole thought process was like, something's not right here. My dad had struggled with drugs and alcohol addiction his whole life. Well, after I graduated, less than 3 weeks later, my dad passed away. And so you can just imagine a young man, 24 years old, no longer an athlete, getting ready to move to Kansas City, lost his dad, lost 100 pounds. Like, I had a big kind of breakthrough. And thankfully, I had some mentors that really, really poured into me. And I dove back into my faith extremely hard and full throttle. And that was what saved me. And I will say that I still to this day am very disciplined and focused, but I'm obsessed. And I think that's good when you can direct that obsession to the right way. So when I got into real estate, it's because I was fired from my last job. I was at a 6-figure sales job and just been married, and I hated it. I just did not like it at all. It just was not for me. I was reading all the books, I was bringing stuff, and it was like, hey, that's cool, but like, this is our process and this is what you need to do. Pick up the phone and call. I was like, okay, that's fine. But I did that for about 15 months. And then one day I came in and I got called in early, and I knew I was getting fired. And so I was fired. And I had this feeling when I was walking out of that building I brought my own cardboard box with me so I could put all my books in there. I was walking out and I was like, man, I feel light. I feel weight off of my shoulders. And I got a call from my wife. She's like, hey, what happened? I told her. She's like, hey, just check your email whenever you get home. My wife had already started what is now my holding company in real estate. She said, I've got your back. I support you 100%. So I started a sales consulting company. I just wasn't sold on real estate quite yet. So I wanted to take everything I had learned in sales and try to make some money. And I did. I was very successful with that. But I was also the head of acquisitions for a $50 million fund at the same time. So I had 2 full-time jobs, working 18 to 20 hours a day trying to keep up. And my wife said, she's very strategic. She said, all you do is complain about this sales consulting, and all you do is talk about real estate. And so 6 months in, I dissolved that sales consulting company and really went full tilt on real estate, not just with the fund, but started to find out-of-state buyers with 1031 exchanges and started representing them in larger transactions. And that's kind of what led me to understanding the real estate game and what I was good at. And so I went out and bought a couple properties myself, quickly found out that I need a team, and I'm good at some, but not at all. And, jack of trades is a master of none. A jack of all trades is a master of none. And so I figured, let me try to build a business. I need to find people to do that. So kind of the who, not how methodology. And so I took another 12 months, continued to broker larger deals, had a new model in the brokerage world, which is still to this day working, and found my partners. And that's when I said, okay, guys, I got this thesis, I've got this skill set, and they brought other, comparable skill sets, but in different areas of the business. And I said, I think we can start doing some real estate together. And so we started off, we bought a 39 unit, and then we bought a 26 unit, and then we bought a 12 unit, and then we bought a 426 unit in the middle of COVID. And so then COVID happened, right? And, we saw this opportunity to say, okay, fundamentally, I don't think multifamily real estate is going to change. Supply, demand, everything. Basis is still pretty low. If you can go find debt and equity right now, you're probably going to be all right. And knowing Kansas City as well as we did, we were able to purchase about 1,000 units in 12 months. And so that's kind of what we do now. Is I think we're up to about 1,400 units across 4 states. We've really been building the operational team. We have 20 employees. We're self-managing a portion of our portfolio and really focused on making sure that we beef up operations, kind of like what Sam Zell did when he saw kind of the writing on the wall, like, hey, these asset prices are really high. I'm going to go build a property management company to be able to intake all of these distressed properties. Not saying that there's going to be a big wave, right? But I mean, everything happens in cycles. Talk to or read Howard Marks, Ray Dalio, Sam Zell, the guy at Starwood. I forget his name. He's a Barry Sternlicht, I think. I mean, all of them, right? They all talk about these cycles, and we're young. And so we just haven't experienced some of these. Sure, we've experienced COVID, but then, the Federal Reserve really just inflated everything to make sure that, we didn't really experience the pain that we should have felt, right? And that was a good thing, by the way. I would much rather have gone through what we did, not to the extent, but then dropping into a massive recession. So I'm not saying that that was a bad move, but I am saying that the Federal Reserve could have stopped doing what they were doing with quantitative easing the last 6-7 months. And that might have changed the game a little bit, but that's a different whole podcast in and of itself. And so where we're at today, what do I see? What do we focus on? Well, operations is one. Two is looking at different types of assets other than multifamily, where I think there is a margin of safety. So we bought an office building. We're under contract on 3 neighborhood retail shopping centers. We're doing a ground up multifamily development that's just ready for the vertical. Horizontal infrastructure is all down. So just pivoting into opportunities that I see now with the macro landscape that we've had and all of this capital that's been chasing all these opportunities and just trying to stay relevant in today's marketplace.
Wow. Well, fantastic. I mean, there's so much to hit on there. And I want to start with just going back to the personal level of your story and sort of how you built the foundation for yourself, mentally to be ready to launch and be as effective as you've been in the real estate world. And definitely congrats on all of the recent success. I actually think you guys, when I look back and hear your story, I think there's a lot of parallels to sort of the growth that we've been seeing in the last 2 years. So it's been really neat to be able to watch you guys and see everything that's going on. Definitely inspiring. So starting off on a personal level, I mean, you're, like you said, you're obsessed, you're disciplined, you're focused. And I think that a lot of great leaders are that way, right? It's a 24/7 thing. Do you feel like you've always been that way, or do you feel like that was triggered at a point in your life? Was there a certain moment in your life where you really started to turn it on and go 100% like that?
Yeah, I will say that I am gifted with certain talents such as discipline, focus, achiever, competition, individualization. So those things do help me in those regards, but those are only talents. They need to be cultivated into strengths. So what I did was I took stock of who I am as a person when I was going through that identity shift, right? I read Strength Finders 2.0, took the test, took it again 6 months later, took it again, continued to focus on that. Emotional Intelligence 2.0, same type of situation, really trying to understand who I am. Colby assessment, all of these different assessments to try to say, okay, what are my strengths and what can I bring to the table? I'm not the smartest book guy, but I'm a learner. And I have great input opportunities as a talent as well. Those are also in my top 10. And so I love to learn. I love to get better. But I think this was really rooted in me when I was a young man. When I was 14 years old, I saw my dad spending money on drugs and alcohol and all of these different things. And my mom working 2 jobs to keep us in, Catholic schools and keeping food on the table. I never had new shoes, but I had food. I never thought I was going to go hungry. You know what I mean? But I always had garage sale clothes and all that type of stuff. That's just the way it was. And I just think when I was 14, I was like, hey, I'm going to go make some money so I don't have to do this. Like I bought my first truck. I bought a motorcycle. I fixed it up. I sold it. I've been doing these types of things, these side hustles for quite some time because I wanted independence. I wanted control. I wanted financial freedom to be able to do what I wanted to do. And that's all tied to my higher calling, I believe, which is to help people rise above mediocrity and live out their dreams in life. And for me as a Catholic guy, it's to get to heaven. How many people can I bring along with me or help get to heaven? And that's kind of the message that I'm trying to spread. And the way that I do that is understand yourself, take stock of who you are. You're going to have weaknesses. That's okay. Everybody does. But don't shy away from those, lean into them and figure out what your strengths are and really understand that. And that's what that 7-year journey really took me on. I read 750 books. I still read, books to this day, but they're highly focused now. I read less books and more depth on certain topics because I know what's going to impact my business. And, at the end of the day, I'm greedy. I'm greedy because I want to be better and I'm not okay. The biggest fear in my life, I steal this from Eddie Milet. My biggest fear in life is passing away, meeting my creator and him showing me the guy that I could have been. That is my biggest fear of mediocrity. And so everything that I do is really impacted on that. Now I'm a family guy, right? I've got my wife, I've got 2 children. And so now I have little people looking at me on a regular basis, and you can talk as much as you want. But Isabella, my daughter, she always says, where's mommy? Well, mommy's working out. Where's daddy? Well, he's downstairs in the gym working out, try not to raise my voice, certain things like that. So it was a long journey still on this journey today, trying to sharpen the sword every single day and try to put myself around people who are playing the game at a higher level so I can do the same.
Mm-hmm. Now, you probably spend a lot of your time these days focusing on, like you said, who, not how, right? And I think that really is the biggest challenge, right? Someone I spoke to early on that helped me when it came to thinking about how to scale the business said it's not just about analyzing your own strengths and weaknesses, but you start to look at the team as one giant organism, right? And look at where are the team's strengths and weaknesses and where are we missing? Who do we add to that? So let's think about when you first were starting the investment company, what were those either blind spots or weaknesses that you found in yourself that you were able to partner or hire for? And what do you think those are today? And where are you putting the most focus?
Yeah, I mean, I think that for any business, I mean, when you get started, it's usually an entrepreneur who gets in there, fixes problems, good at sales, good at marketing, kind of good at everything, right? But at a certain point, you get to a certain level where you start to top off, and meaning your time capacity is just kind of zapped. And everybody talks about work-life balance. There is no work-life balance in this business. It's all about counterbalancing. And it's how out of balance you can get in your work, which is important. You can go out of balance in your work, but less out of balance in your personal life. So early on, it was, hey, just bring it over here. Just bring it over here. We'll handle it. We'll handle it. We'll handle it. Well, you get to a point where you can't handle it all anymore. And so this was just to give you a prime example or a real life example. It's like pipeline, right? Like you go out, you work on pipeline, you try to find deals, you try to find deals, you try to find deals, boom, you get one or you get two. And then you're so focused on working on that deal that guess what doesn't happen? You don't fill the pipeline up, right? And so now you've got this cycle of you're doing deals, but you're not.
Oh yeah. Yep.
So it's to the point. This is a good example of how do you find a way where you can keep the pipeline full at all times, but delegate and elevate the right people to execute on those other opportunities. So for us, right, first it was, we got to get operations. That's number one. So we hired director of operations. We have our chief of staff, director of admin. We have marketing now as well, investor relations, finance, asset management, all in-house. But all of that happened in the last kind of 8 to 12 months, right? And so for us, it was let's think about all the things. And what's most important right now was operations, then it was marketing, then it was finance, then it was, investor relations and acquisitions. And so, and now we just recently hired an analyst who's helping get through so much more deal flow. So I think that's kind of the struggle for any entrepreneur or any business owner that's scaling. I mean, there's some staggering stats, and I don't know them off the top of my head, about how many businesses actually get to $1 million in revenue. It is a very small amount of the actual businesses out there. And then the amount that get to 10 million is like cut in 50 to 75%. And then 100 million is another 50 to 75%. And this is because of this, right? It's because of they can't figure out how to remove themselves out of certain activities because it feels like productivity, but it's actually not. So, yeah.
Yeah, I think that is so relatable for so many operators. I remember the point where if I had one deal under contract, it could feel overwhelming at times, one or two deals even, right? And now it's today, and more recently, we've had points where we've had 5 or 6 deals under contract at one given time. And the only way to do that is by having systems and the right people there. And it's also about, I think you hit on the order of importance when it comes to hiring very well, because I've always said that there are some balls you can drop and there are some that you can't drop, right? So like acquisitions, building your pipeline, that's a rubber ball, right? It'll bounce back. You can rebuild the pipeline, rebuild the relationships. Obviously you don't want to, but it is something you can do, right? Investor relations, right? Obviously, again, something you should always be there very active with, but it is not going to be catastrophic if you drop the ball for a week, right? Whereas operations, that can be catastrophic, right? So that's always the glass ball. And I think you and I were talking about this right before about how on the operations side, that is where I think, at least for me, and I'm sure it's the same on your end, it feels like there's always something screaming at you, right? And it's always the thorn in your side. There's always something that's screaming at you that needs attention. And it's usually the squeaky wheel that ends up getting the grease. And therefore, a lot of your early resources are hiring for operations. I know that for us, we've pretty much built the business exclusively around that to begin with. Yet at the same time, to really scale the business, you also need to be balanced in the sense of having effective investor relations and acquisitions and the business development side, and then having the operations team that's I like to say overstaffed at times to be prepared for the scale and the growth that takes place. Speaking of operations, you recently brought property management in-house. So what was it that inspired that decision? How has that gone thus far? Any big learning lessons that you'd like to share with the group?
Yeah, I mean, at some point, for investors and or other sources of capital, they have to see that you're vertically integrated. And, I think the biggest piece is just the control, not being able to positively affect change across the organization and the properties through working with a third party, property management company is tough, especially at scale, especially at scattered site deals that don't necessarily warrant a property manager there on site.
Mm-hmm.
So that being said, it's like nobody's going to manage the properties like you will. And so we figured, what better time if we're not able to purchase, which, is a different story, that is, to build that up, right? So one is track record, two is control, and three is making sure that we can positively affect change across that vertical in our business. When you're transitioning properties, it's not easy, and there's always going to be, things. We've learned a ton, but collections are already up, and rents are already being pushed, and leasing is already up, and so I mean, just having a pulse on that is so important. I would say in a business to be able to affect that change is why we
do you feel like it has made your life much busier, hopefully in a positive way, but do you feel like, because in a lot of ways, if you're using third party, it's a silo, right? And you don't always hear half the stuff that's going on behind the scenes with the third party manager. And then once you sort of crack open the silo and you become vertically integrated, I feel it often floods you with additional items, but now at least, while they can be uncomfortable, at least you know what's going on at all times and you have a pulse on that. So I guess, has it made your life busier, and how has it changed just the team dynamic since you've went in-house?
Well, I think anything that you're starting up, like there's always going to be 100% more time that it takes at the beginning than it does when you're scaling. So right now we're still in that space. So yes, it's taking more time right now to get the systems, the people, the processes all put in place. But I'm sleeping a lot better knowing that we are able to affect change, and we have the right data, and we know what's going on at a much higher level than we did before. And so I don't foresee it causing more kind of bottlenecks in regards to the time that the principals have to spend for that, because we've hired a lot of people to kind of help out in that organization. But right now, getting it set up, yes, it's quite a bit, obviously.
Yeah, but it's time well spent, like you said. There's no better time spent than improving the operations and performance on the portfolio. So let's talk about today's market. Right before we started the call today, we were talking about how you're seeing deals trade at next to nothing yields, and we're seeing the market continue to get more aggressive along this bull run. And you're talking about staffing up, beefing up your operations before any potential corrections, things along those lines. So obviously we're not here to try to predict the future, just simply prepare. So maybe you want to share with us your view on today's market pricing, different asset types that are exciting you right now, strategies you're pursuing.
Yeah, look, I'm open to understanding the supply and demand kind of situation that the United States is in, and that single family home prices continue to rise, and as they do, and interest rates rise, that prices out millions of other Americans that want to, and so they're forced to rent. So I think there's more renters by necessity now than ever. Obviously COVID. We had a big supply issue because of all the things that were going on. So deals got put on pause, price because of pricing with construction and all of these different pieces of the puzzle. But that being said, I'm not smart enough to know that there isn't still trillions of dollars that are just waiting to be pushed into United States commercial real estate and multifamily specifically, especially now that Europe has now started to kind of adopt the multifamily mindset. And what I would say is that's a relatively new asset class for Europe. And now if you're European and you're investing, you're probably not trying to invest anywhere close to Ukraine or the Eastern Europe country. So what's that going to do? That's going to push even more dollars probably into the United States. And so I'm not smart enough to know like what that means. There's guys like Peter Lindman and Hunter Thompson that really dive into and Spencer Levy, can cap rates continue to compress and all of that. And the cost of capital is lower than it ever has been in a lot of fronts. So I'm not saying that buying these deals is a bad, investment thesis, but it's not the right one for us. And I think that's a big delineation that needs to be made is my cost of capital is much higher than a lot of these other type of institutions or people that are looking to just place capital because one, they might be afraid that the government might take their money. And so buying a 0 or negative in percent yielding deal, they're just parking it. It's a bond. It's a safe haven for them. And there's a lot of those dollars out there. So with that being said, what I'm seeing is cap rates, even below 4s in Kansas City on certain types of assets. And so our value add strategy, which is to go in, have some sort of cash flow day one and be able to force appreciation, put long-term debt on these projects and feel comfortable that we're going to be able to continue to push value. That margin of safety has gone from this to down to this. And so it's compressed a lot. So for example, we just underwrote a 450 unit project in Kansas City at a 3.3% cap rate. And, debt probably is going to be higher than that on the project. And so that's just a risk that I'm not willing to take. Our investors are not interested in, and we aren't interested in operating in that space because we know how difficult it is to operate these deals, and our cost of capital is much higher. So with that being said, I'm cautiously optimistic. I'm still bullish on multifamily, but I need to find kind of assets that are distressed, direct to owner. They need us to help. And that's going to be, those take time, and it's a dime in the dozen. It's a needle in the haystack. And when those come, I will jump on them. But there are trends that are happening in regards to the work from home or return to office or e-commerce, or, we're watching all of these different things that then impact these other asset classes, right? I mean, so for us, it's really thinking through, okay, what are some of these macro trends that were already happening pre-COVID that COVID exacerbated that we can capitalize on? And, everybody wants to say the Amazon effect. You know what? 13% of retail deals are still done online. That's out of 100%. So there's still a lot of retail deals that happen in bricks and mortar. You're going to see more experiences. People want to get out. They're trying to get out. They have revenge travel going on. Well, what do you do when you travel? You go to retail shopping centers. The wives go out and shop. The husbands go play golf, whatever it is. And so all those trends impact kind of certain asset classes. And so what is happening, there's headlines that people are saying, okay, well, people are going to work from home for all times, and forever. Not really. You have to get down to the use case of each project and each demographic and each geographic location. So for example, an office project, who are the businesses that are actually in that office building, right? Do they need collaboration? Do they need to get in and, converse with other people for the good of their business? Do they want to work from home anymore? I don't know about you. You're in Tampa. I just got back from Florida twice. I love Florida. There's no mask mandates there. Everybody's going. A lot of people are going back to the office. In Kansas City, people want to get out of their homes and get to the office. And so it might be a hybrid approach, but that doesn't necessarily mean there's going to be less demand. There's a flight to quality in the office space. So maybe somebody had 3 locations. Well, they might aggregate to that one location, and that building is still really good. So it needs to be location when it comes to retail and office. On the retail side, it's really important to have e-commerce resistant service-based tenants, hardware stores, dollar stores, the restaurants, all these different things, the tire centers that you have to go to and get your, what you need, the grocery store, all those different things. Yep. And so there are opportunities in these asset classes that other people are kind of brushing over because of how stellar multifamily and industrial has been over the last 2 years as a safe haven asset that are now priced to the point where it's like, hey, there is a 9 cap here on a neighborhood retail shopping center that's cash flowing day one. And if I can get 4% debt, I got 500 basis points of spread. Remember that multifamily deal I talked about had negative spread. And I'm
Yep.
talking about a 500 basis point spread. So just thinking through that and thinking through modern portfolio theory for our investors, they have a big exposure to multifamily, more value add, so less cash flow at the time being, and trying to keep my ear open to different opportunities and making sure that, I'm really, really vetting these opportunities, but explaining why we're bullish on assets outside of the multifamily space.
Yeah. So I absolutely want to commend you for thinking independently and dynamically with and adjusting to the market, right? I think what Logan is sharing, I believe a lot of sponsors out there have these questions at times, but they just won't be public with them, or they don't really explore them or question their own thinking, right? Because they oftentimes are following the crowd. And today's theme of the day is multifamily, right? So I think that it's not always easy for an operator and sponsor to come out publicly or come out to their investors and say, guys, look, where things are at right now, we might end up doing less deals, right? We're probably going to be doing less deals. We have a harder time aligning with today's market, right? Obviously, you know that you make more money the more deals you do, right? That's how you're compensated. You have a great investor base. You absolutely could be going out there and putting a lot of deals under contract left and right. Yet you're really thinking about what's in the best interest of your investors and making sure that there's an internal alignment with your own core beliefs to that which you're providing to your investors, saying, well, this is a truly good risk-adjusted return relative to what the market offers in other areas, right? So I think it's definitely something that takes courage to be able to do. But I also think that I'm sure that's going to be reciprocated by your investors having continued confidence that you're not just there to sell them on any deal or just continue to adjust expectations constantly, right? You can certainly, they'll know that you're willing to walk away when it doesn't align with your personal core beliefs. So definitely, I just think that's important for everyone to hear and understand. And I think it's also ever changing, right? I think that you're probably questioning your own beliefs and your own viewpoints probably daily, right? To be able to determine what do you believe in and how is the new data information you're taking in impacting that. So would you say that for you, what would you say are the key things you like to see in an investment that sort of checks the boxes for you? Are you able to break that down?
Yeah. I mean, for us, it's, what's the basis? I mean, let's get back to basics here and talk through replacement costs versus what you're acquiring it for. I can look at a deal and we can go through our full underwriting with our underwriting team, and then our analyst gets it, and then investment committee. And I can look at where the rents are, what the submarket is, or where it's at, and say, basically, we're going to be able to offer, kind of on the price to rent ratio, 1% on the price per door that we're getting. So for example, if it's $100,000 a door, we probably need to be somewhere between $900 and $1,000 on current rents. Right. And so, that's just hard to find right now. And so you're seeing deals that are, at $100,000 a door that have $500 worth of rents current. And yeah, maybe you can get to $1,000 at some point, but I'm not willing to take that risk. So that's kind of the first metric. We're also pushing to newer assets. We have a lot of 60s, 70s product. Our last two multifamily acquisitions, we closed one last week, was 1995 and 2015. And so you'll see us kind of buying newer assets because Class B and C spreads have continued to compress together. And so if I can go get a Class B 2015 asset at a 5 cap, or I'm taking a 1970s deal down at a 5 cap, there's just a different type of risk in regards to both of those. It's also very important to understand where our portfolio is right now and how much allocation we have to certain business plan implementation on those asset classes as well. So those are a couple things that we look for. We're Midwest investors, so Missouri, Kansas, Nebraska, Iowa, Oklahoma, Arkansas. That's really where we spend most of our time. Affordability is one reason. Stable is another reason, and less competition is the third reason.
Mm-hmm. And how about on when it comes to the office space or retail, which of them are you bigger on out of the two? And what are the core things you're looking for? I know you mentioned vetting the companies that are going to be living in that,
Sure.
but how would you expand on that?
Office, very, very, it needs to be very specific, right? So we bought an office building last year, mainly because we needed a space, but we also know that the streetcar is coming right down the street and stopping out in front of this building. And so watching all the redevelopment happen across Main Street has been excellent to see. That will help rental rates. We were able to lease up the project before we even closed, which was exciting. So did all these kind of really cool things on that office deal. I will say that if we're going to go buy another office building, it's likely going to be suburban office and class B plus or higher. So making sure that the flight to quality is going to attract those residents, those tenants in those buildings. Parking is really important for
because
office.
the employers need to attract their people now to the office, right?
That's
because
exactly
now
right.
you have work from home as the other option, right? So it can't just be this dual office, right? You need to really have something that's going to draw the people to show up just as well, right?
Yep. So where do the people live? They live in Kansas City. A lot of them live in the suburbs. And so they don't want to drive from Overland Park or Leawood all the way downtown and get caught in our little bit of traffic that we have here. Not much, but our little bit. So, I mean, that's the office side of things. Then it needs to be, okay, what's the tenant mix? Do we have lawyers in there? Is there a bank in there? Is there finance companies in there? Okay, that's great. How big is their company? What's their revenue? Okay, what percentage of rent is that for their revenue? Those types of things are all pieces. And then what's the vintage? You know, we like newer office buildings. They're not building a whole lot of new office, which is okay. I mean, that's good for the supply side of things, but there is a flight to quality and, you know, how hybrid can this be, right? So open floor plates. And if they have 50 people in the office one day, but 150 the next day, can the space accommodate that? So just thinking through things like that on the office side of things. Retail, we're much more bullish on. So we love neighborhood retail shopping centers. So retail shopping centers that are planted around multifamily and houses. You know, the ones that you drive by when you head to work and when you come back from work, you have to stop in, get your gallon of milk and all those different things. That's really important. Traffic counts. Minimum has to be 25,000 on the traffic counts for these retail centers. How easy is it to get to? Do I have to go down a one-way street or do I have to go one way, turn back around and then come back the other way to get to it? Or can I just turn left or right straight into the center, right? Like that's a big thing that we think through as well as traffic counts. And then the tenant mix is really important. We like to see kind of a mix of national, regional, and local tenants in there. The spaces are really important. So what's the visibility? Where's the signage? How hard is it going to be to release this space? When's the last time that the landlord put any contributions into the building? Okay, what are those contributions? And if we have to release, are we gonna have to demo the whole thing and then put in, you know, another, you know, big chunk of money for tenant and landlord contributions? And then the weighted average of the lease terms, you know, how much time is left on the leases across the building? That's another part that we're looking at on these shopping centers as well.
So I know your motto is do well by doing good, right?
That's right.
And where do you envision the business going in the next 10 years? What's your big, hairy, audacious goal?
Yeah, I mean, we're working towards the $1 billion in assets under management. I'm pretty confident we're going to get there. I think for us, doing well by doing good means the work that we're doing to do well, right? We do it good in a way that can serve the people that we're working with, whether that be vendors or the residents and businesses that we're, you know, operating or occupying our spaces. Well, and then it's the employees as well. So lots of opportunities for us to kind of give back, and in the way that we do our business to give back too. I mean, real estate's cutthroat, man. I mean, it's out there. You can treat people bad. A lot of people do. That's not kind of our MO. So making sure that, hey, you know, if you want to work with us, we're going to do it the right way, and everybody's going to feel good about that. And if not, hey, we have a no a-hole policy in our business. And so it's just like, look, if this is going to be, you know, a tough situation to work together, we're not interested in doing that because of the drag and the bottlenecks that will create later on. And so I think that we try to find places and organizations. For example, Parker and I sit on the board of directors at a nonprofit here working to end homelessness. Well, that's perfect for us because we bring the real estate knowledge, we bring connections to help get these people rapidly rehoused and get them the services they need to be contributing members and get their lives back in order and try to be, good family people. So I think that's really important for us as well. And figuring out how to get our employees the opportunity to not only invest in these projects, but be owners in these projects. That creates kind of a level of buy-in that you don't necessarily have at a big organization.
Love that. Yeah, I think you share a lot of parallels. We're doing a lot to think about how we can invest people into the projects that we're doing, get the entire team contributing to making the whole pie bigger and having true ownership. And at the same time, I am excited because I believe you are working on your first mobile home park, or
we are.
Is that right?
Yes,
yeah,
absolutely.
So I thought that's really great to hear too, because I think we've taken, a lot of our team comes from decades of multifamily experience and everything up to A-class properties, right? And you look at an underserved space like the mobile home parks have been traditionally, just the little things that you can do, giving, welcome cards, welcome baskets, you putting on resident events on a monthly basis, celebrating all the major holidays, those sort of things that might be an expectation in a lot of traditional multifamily will just give you, raving fans or residents for life, right? When it comes to the people in those communities. So I definitely think that taking that approach, over the long run, I think your profits will follow just as well too, right? People will pay for places that they can call a home, not just a house. I'm excited to see how that plays out for you. So give us two best practices. One best practice for active operators that are looking to get into their first or early deals, and give us one best practice for passive investors that are vetting an opportunity.
Yeah, I mean, for active operators, I think this is the time to really reinvest into your systems, your processes, and your people. And so make sure that you're focused on developing yourself as a leader. I joined a local faith-based CEOs group just so I could be around other local leaders and folks that have grown businesses. So I think that's the really important thing is making sure that you can attract and retain the top talent so you can delegate and elevate. On the passive side of things, you really have to understand what type of debt are going on these projects. I mean, everybody talks about raising equity, and that's important. But a lot of these projects being done right now are because they're being done with bridge lenders who are sharks. And they know if anything goes wrong, they can execute one of their debt covenants, and they will not give you much more leeway other than saying, hey, we're taking over. So understanding the debt on these projects is the biggest capital stack component on most commercial real estate deals, I think is so important. Understanding where interest rates may or may not go, but how is the operator going to hedge against that, and what are they doing in regards to that? So I think that's important. Exit strategy is really important. I would say that really thinking through the macro trends in regards to the demographics is really important as well. And what I mean by that is I've been reading a book. I've got it right here, Big Shifts Ahead, from Chris Porter and John Burns, and they are really dive into the demographics of the United States. So just really understanding that, there's 77 million baby boomers in the United States. Every day, I think 10,000 people turn 65, and like 5,000 people turn 85. I might have messed those numbers up a little bit, but you get the drift. Like, people are getting older. So how is that going to impact the investment? And understanding the exit strategies is really, really important. And obviously doing your real qualitative due diligence on the sponsors with conversations like this is really important too.
Love that. Yeah. The risk is never visible in the pro forma, right? It's never shows in the IRR, right? You have to back into what's behind that. How much leverage is there? What type of debt is it? I think it's all great advice. And Logan, where can listeners best follow along with you, your company, and find you online?
Well, I appreciate that, Dylan. I post daily on LinkedIn, Logan Freeman, Mr. Kansas City. If you want to dive into what I'm thinking about, I always post on there. Our website is ftwinvestmentsllc.com, and we write a weekly blog over there on that website as well, so people can tune into that too.
All right. Well, You heard it, folks. Well, definitely make sure you plug in with Logan and follow along with everything that he's putting out there. Thanks so much for jumping on the show. It's always great to connect with you.
Yeah, thanks for having me on, Dylan.
Thanks for tuning in and joining us on another episode of Operators and Allocators, hosted by the REquity Group, a vertically integrated private equity real estate company. You can find recordings of all shows along with other resources on our company website, therequitygroup.com, also listed in the show notes. A brief disclaimer to our listeners. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. All investments are subject to risk and past performance is no guarantee of future results. The views and opinions expressed by the REquity Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions. We hope to see you next week.